Okay, what's up, tycoons? What is up, traders? Going to give you guys an update on my dividend slash wheel portfolio. If you're not familiar, I haven't made a video on these in a while, but the reason being is I haven't really bought or sold any shares. But here recently, I did sell some option contracts. So if you're not familiar with the wheel strategy, we'll go over that and which stocks I'm running the wheel on. But essentially, it's owning, 100 shares or more, and then you can sell covered calls against those shares to generate passive income. And if you want to purchase a stock at a lower price, you can also sell cash secured puts to generate some passive income as well. So we'll break down, the stocks, and I was able to collect $280 in premium. Okay. And that's for doing nothing, right? That's for agreeing to sell some stocks at higher prices than what they are and agreeing to buy some stocks at lower prices than what they are. You can use this strategy, the wheel strategy, to go ahead and create some passive income. And, it's Saturday at the time of this recording. So on Friday, I did sell some options and was able to generate $280. Now, compared to the total account value of $57,000, that's about a 0.5%. But when you're looking at the long term and you can do stuff like this month over month, that really adds up, right? That's basically another 6% you can create passively just by wanting to sell or purchase stocks, at prices that you feel comfortable at, right? So that's what the whole video is really about. We'll go over what positions. We have some nice charts here too, portfolio breakdowns, and as far as asset allocations. Now, I do have a large amount of cash, not entirely cash, but in this portfolio, we have about $13,000 cash. And the reason being is so you can sell those cash secured puts on stocks you want to own, right? If a stock is $50 and you want to, buy, or you want to sell a cash secured put at a strike price of $50, you need $5,000 in cash to go ahead and actually sell that option contract. So that's why we keep cash. But there's 38,000 invested currently in here, and it's up to about 43,000 in the stocks that we have invested. It's about a 12% gain. Okay, very close to 13%. We'll go over my top positions. If you look at asset allocation, I've got about 1% in crypto related stocks, specifically BKKT. And then we've got water right here. Water is something that I think is very, very slept on, right? Water's not going anywhere. And, lots of billionaires are buying up lots of water, right? And it's really interesting when I started to hear about that about a year ago. I really started paying a lot of attention to water, and I do think that that's something that has some great long-term potential, right? If you're looking for something to continually dollar cost average in over the next 15, 20 years, I like water. Right now, this isn't me telling you guys to buy anything. This isn't financial advice. We're just breaking down the things that I'm holding in this portfolio and why, kind of what my mindset is behind them. Not that you guys should mirror or copy any of these. We'll take a look at, the percentage gain and losses, and, there's plenty of plays I'm up on, and there's plenty of plays that I'm down on as well. So definitely not a perfect trader, or, investor. Not saying that. I've got about, it used to be a higher percentage, but that, some of the other things have outperformed, and this is, underperformed a little bit. But I'm in biotech. I've also got about 9.5% in growth, and then about 60% of this portfolio is really in dividend stocks. Now, they're not in strictly dividend stocks, but when it comes to stocks that are paying dividends, about 60% of this portfolio is in dividend stocks. When you look at the sector allocation, I've got about 12% in index funds, 12% in essential utilities, 40% in energy. I've been really overweight in energy. That's a huge hedge against tech. And, really, I got into my energy play at the end of 2021, and it's really just been a really good position for me, and really outperforming the rest of all of my other positions. Been a huge part of my gains. Okay. If you look here, we have consumer discretionaries, 21%. Technology, about 7.6%, 1% in cannabis, about 8% in industrials, and over 4.5% in clean energy as well. So energy really takes up a big portion of my portfolio. Most likely I am going to be trimming that, but not extensively. Okay, you got to let your winners win, let your runners run. That's a big mistake that a lot of people make is, oh, hey, well, this thing's performing good, I better sell it now. And then they go buy something else that's probably underperforming. And what do you see? You see the underperformance continue, and you see the outperformance continue as well in the thing that was outperforming. So here it is. We've got ZIM, Now, this is a shipping company, okay? And in the city that I live in, they do a lot of work. It's actually an international shipping company. Maybe not the best sector or place to put your money right now. As you can see, I'm down 28% on it, about 29%. But the reason I have it is because of this large dividend per share. They pay $27 and $55 dividend per share that you own. If you look here, that's a 148% yield. Now, a lot of times these companies with extremely high dividend yields, they're doing that for a reason, right? It's not always a great sign that a company is in good financial standing. They're doing this to attract investors, right? And it's working for me. The current price is 18 bucks a share, but they do pay that dividend of, what was it, $27.55 a share. So even if this position goes down 90%, I'm still going to be getting a really good dividend from it to make up for those losses, right? So that's basically completely why I have that one. Is strictly for the dividend and kind of just dividend yield chasing. Again, not a the best investing strategy, but really, once I get that dividend payment, I'm probably going to be selling this position. Now we have METV over here. This is a Round Hill Ball Metaverse ETF, and don't let the metaverse name scare you, right? A lot of people are either do or die when it comes to the metaverse, and they think that it's complete trash or that it's going to be the next big thing and take over the world. The reason that I like the metaverse ETF is because chip companies are going to be the companies powering the metaverse. So this is a really cheap stock. And when I say cheap, I don't mean valuation wise. I mean cost wise. It's $7 or it's the current price is $8.71 a share. And for that $8.71, you can get good exposure to the top chip companies, right? To the top software companies. It's got Microsoft in there. It's got Meta in there, Facebook, obviously, of course, as well as many other companies, but AMD and Nvidia and some of these other chip companies are a lot more expensive per share when it comes to a dollar value. Again, not a valuation value, but at $8.71 a share, you can own a slice of some of the top tech companies around. So that's why I like this ETF, right? It's a good way to get some exposure to tech, and you can stack up 100 shares for less than $1,000 and start generating some passive income selling covered calls. So that's why I really have this position. Okay, now MJ is another position that we've got, alternative harvest ETF. This is basically the cannabis ETF, right? And I do think that eventually, once cannabis is federally legalized, right, and that may never happen, or that may take 10-20 years, right? So it's pretty risky investing into cannabis just because of the regulation. But I do think eventually, in my opinion, we will see that regulation pass, okay, and get passed, and we will see it federally legalized. And the ETF is a nice way to not have to pick and choose individual companies. As companies, new companies come in that start to take over the market, they'll be added into the ETF, and underperforming ones will be taken out, so on and so forth. We have Gilt right here, Galat Satellite Networks. Now this is probably my least favorite position. I did like a lot about them about a year ago when I was getting into them. But I'm definitely down on this one, down 32%. Out of the ones we've looked at so far, METV has been my best performing one, up 17.39% on that one. And you can see that these are all relatively small percentage of the portfolio, right? We got 4% in Zim for the high dividend. Okay, 2% in the METV. We got 1% in the cannabis, and 1.6% right here in Gilt and Galat Satellite Networks. BNGO, I actually like this one a lot. I sold some cash secured puts on this one. If you take a look and we go over here, BNGO, I would like to own some more shares, right? So I sold the 1.5 strike, meaning if by February 17th, the expiration of this option contract, bingo, BNGO is below $1.5 a share, I'll be forced to purchase 100 shares at that strike price. Now, I did receive $3 in premium for that. So that really puts, the average cost back. It lowers the average cost a little bit, right? So instead of paying $150, I really paid $147 for 3 shares, or for 100 shares. And that would bring the total price down to about 1.47. If you look at my average cost on it, it's at 2.10. So, I don't mind buying a company that I want to hold at a cheaper price, and, generating a little bit of passive income, even if it's not a big amount in relation to the amount I have invested. It's a much bigger amount than relative to the portfolio, that $3. Now we have Fubo in here too. Fubo is kind of I kind of got this to piggyback off of Netflix, as Netflix was really destroyed. And also, there's a lot of hype around this one. It could be a potential short squeeze stock. So, I do have a small position in this one, but man, I tell you what, stay away from those meme stocks, guys. This one down 38%. Okay. I've got 300 shares, lost about $462 in this portfolio off of Fubo. And, that's what happens when you try and mess around and, rather than just trading a meme stock when it's rallying and getting in and out, taking a small percentage gain, and you end up holding these things. Earnings, I think, was really what did it and started to, really shoot this thing down. But we've got a new earnings season coming. So we're going to see what happens with Fubo. Jumia is another one. Jumia is technically consumer discretionary, but Jumia is not too bad, right? I mean, it's supposed to be the Amazon of Africa. It's a very risky play. Just betting that Africa will actually be able to get some economic infrastructure over there and actually grow. But if that is the case, then Jumia could have a really big market share over there, and has a lot of potential, right? It's high risk, high potential for gains. iClean is one that I really like a lot. Okay, we're starting to get into some of the bigger slices of the portfolio now. This is 4.7%. This is the clean energy ETF. Now, Biden recently did his infrastructure bill, or not the infrastructure, but the Inflation Reduction Act, which is actually going to be helping out a lot of energy companies and giving lots of money to energy companies over the next 10 years. And I do think that clean energy, as well as other people think this as well, that the demand for clean energy is only going to go higher, right? And they're really trying to get rid of the fossil fuels and oil and things like that, but those aren't going to go anywhere soon. All right, so I do have a big position in energy. We'll get into that, but I really like clean energy. And again, just going the ETF way, right? I'm not choosing to invest in one particular company, letting the ETF, just have a bundle of those. So that way, if some companies fail and some companies succeed, it can go ahead and reshuffle and rebalance accordingly. But overall, I do think that clean energy is going to be something that continues to grow over the next 10 to 20 years. We have KMB in here. I got this one for the dividend, and it was at a pretty good price when I bought in. I'm actually up about 12.19%. I'm up 13, close to 14% on iClean, but up 12% here on KMB. Now, it is pretty pricey, so I don't own 100 shares of this one. I own more than 100 shares of all the stocks in this portfolio except this one, and I really just don't want to put, over 10K into KMB when I'm really just in it for the dividend. It pays a nice dividend, but I was able to get in at a good price, and maybe if it would have went lower, I would have added some more shares. But that position's been doing really well for me. It's up about 12%. Since I got in, made about $700 off of that one. Now, this is the big one that I've been in. Okay, is Gush. This is the oil and gas, basically bullish energy ETF. Okay, Gush. This is the largest position in my portfolio. Put about $12,000 in there off of this. It's up to 17,000, up about 45% on this position. Now, this fluctuates frequently, right? I was up about 75% on this position before, but energy prices have pulled back. So it's still a big slice of my portfolio. I did have, I think, 120 or 125 shares, but I've started to trim it a little bit. I'm down to 110, and I'm probably going to sell 10 more shares, here in about a month or two. It just depends, right? How energy really performs. China's reopening right now. They're, supposedly supposed to be fully reopened. I do think that has the possibility for energy prices to increase. Reason being is strictly off demand. China's huge. They have so many people there, and they trade with over 70% of the entire world trades with China. So now that they're fully reopened, if they're going to be working full time and working overtime, even, it's going to cost a lot of energy. It's going to take a lot of energy to really, do all of that. So, I do think that energy still has a good chance of going higher. PHO, okay, this is the water ETF. Remember, I was talking about water before. This is about 12% of the portfolio, up about 12% as well off of this position. And I kind of went into water already, but I do think that water is something that will continue to increase in value over time. There's a finite amount of water on the earth, and they are working on ways to clean the ocean, right, and make that drinkable water and things like that. But when it comes to water as a resource, it's very finite. And so, the people who control that have a lot of leverage, right? The people who own all the water, they have a lot of leverage. So I do like investing in water. This is BKKT right here, backed holdings. This company is owned by ICE, okay, the Intercontinental Exchange. This is the parent company that owns the New York Stock Exchange. So the reason I have them is because the company that owns the New York Stock Exchange also owns this cryptocurrency stock. So, if crypto regulation ever does come, they're going to be in a prime position. Right now, it's very risky betting on cryptocurrency, especially with stocks. So, it is a small position. It's about a 1% position, but I don't mind getting my feet wet with a 1% of this portfolio, really, into some cryptocurrency plays. It has rallied a lot here recently, but even with the big rally, I'm still down about 20% on it. We have NNDM right here. The reason I got into NNDM is because they were fundamentally undervalued at the time I started investing into them. The market cap was around 600 or 700 million, and on their latest earnings report at that time, they had 1.2 billion in cash. So the company was trading less than the amount of cash that they actually had on hand. So, to me, that's a discrepancy. It's a little bit undervalued. Now they could be burning through that cash, right? They're going to have earnings coming up here soon, and all of that cash could be gone, and then I'll have to reevaluate that position, basically. And the last position is going to be SPY G. Okay, this is the S&P 500 growth ETF, and the reason I'm in this is because I like growth. All right, growth stocks in particular. And it's really just a cheap way to also kind of get into the S&P 500. If you look, the average cost per share is about 500, and I believe the S&P 500, the SPY ETF, is about 405 or maybe 410, somewhere in there at the time of this recording. So, if you wanted to own 100 shares of SPY G, it would simply cost you about, $5,300 versus owning 100 shares of SPY is going to cost you a lot more money, a lot more capital. So, you can invest in this, be able to get the growth sector of the S&P 500, the top growth companies, and be able to purchase 100 shares and sell some covered calls against that. Now it is a little bit risky because it's been a bear market. We've been in a bear market, so growth is going to underperform, but it's all about picking right prices. I am up about 6% on this one. Was able to get in when things were pretty low, and I'm looking to continue to build out this position. Maybe if I take some of my Gus shares, I'll probably get into some more iClean. I'll probably get into PHO, and then I'll probably grab a little bit of SPY G as well, and kind of just let these other positions sort them out. They're a lot smaller. And I'm also up on all of those positions that I just talked about when it came to iClean and PHO. So if we do see some type of a pullback in the market, those are the plays that I want to get in on, is the things that have been winning for me, and just see if some of these can recover. If not, it's not the end of the world. Okay. Nobody's going to be a perfect trader, perfect investor, and I can still generate some passive income, even if the share prices are going down. So over here, we have all of the options that I sold. I sold the 16 strike on Zim. I sold one of those, was able to generate $15 in premium. If you take a look, my average cost on Zim, all right, is $26.14. So if this thing crashes, right, it's at 1861 right now. If it crashes another $2.61, all right, I will be purchasing another 100 shares, but keep in mind, I'll be purchasing them at a strike price of 16, and the dividend per share on those is $27.55. So in relation to that, it's a really, really impressive come up on my end, right? I'd basically be making $11 off of the dividend for those, versus the $16 that I spent on the shares. Now over here we have MJ. I sold some cash secured puts on this one. Reason being, I sold the 4.5 strike price. We're at 4.81 right now. So if I can get in below my average cost, right? The current price is $4.46. If you notice, I basically sold an in the money position on this one, so that way I could collect a little bit more premium. And this is going to bring my average cost at the strike down to about 435 a share. And if if you take a look here again, this is at 481. So, it's a very small position. It would basically be like another 1% of the portfolio, probably less than that, probably like 0.8%. But, I can continue to just establish, and I really want to get in below where the current price is. Things have been bullish lately. So if the market continues to go bullish and this continues to head in an upward direction, then I won't have to buy those 100 shares and I'll just be able to collect that premium. The next one is going to be gilt. Okay, I sold the 5 covered call on those. I was able to generate 75 cents or $75 in premium. And if you take a look here, the average cost on these is $8.25. Its current price is $5.59. Remember, I said that this isn't my favorite position, right? So I'm just kind of using options as a way to possibly sell these shares if it closes above $5. By February 17th, then I will go ahead and be selling those 100 shares. Now we have bingo as well. Bingo, I'm running the wheel on. So the wheel is when you're selling covered calls and cash secured puts. I kind of went over the puts already. I was able to sell some covered calls here. I sold the 2.5 strike. I sold 2 of those contracts. And the reason being, if you take a look at my position, I got my average cost is 2.10 on these. So, if it goes up to 2.5, which is a pretty big increase, it's at 1.85 right now. That would be, basically like another 65 cents. That's about 30% almost, roughly, just doing some rough math here. So if it goes up 30% in the next month, then I'll be forced to sell them at $2.50 a share, which is again above my average cost. So I'll be selling them not only in profit, but also keeping the income that I got from the covered calls. The next one is Jumia. I sold some covered calls on Jumia as well. Okay, if you take a look at my average cost on Jumia, it's at 5.28. It's currently at 4.28. I sold the 5.5 strike. So if Jumia rallies incredibly over the next month and it comes up to 5.5 and it closes above 5.5, I'll be forced to sell all of my shares of Jumia, but still above my average cost, right? And right now where it's at, it would need to go up about 20-25% in the next month for this to happen, in less than a month, actually, in about 3 weeks. Over here, we have Gush. I was able to sell the 200 strike price, collect $95 in premium for February 17th. If you take a look at Gush, my average cost on these is $110. So definitely have no problem selling my shares at $200 a share. If that happens, I'll be fine with it. I can live with that, right? I can live with making $90 a share off of, $110 really originally invested. That's a great return. And then it can allow me to rebalance into some of my other things, such as iClean or such as, water, or maybe even the growth sector, or even if I want to add something new in, right? Maybe I want to stay in energy, but I don't want something leveraged. Maybe I can hop in XLE, things like that. The next one is going to be, PHO. I'm running the wheel on FA. All right. I sold 60 covered call, and then I sold the 45 strike puts. So if you take a look here, my average cost on FA is $47. So if I sell at 60 and I'm forced to sell at 60, that's great. That's fine with me. Selling in profit. Okay, and the cash secured puts is also below my average cost. So if it falls down to 45 and I'm forced to buy 100 shares, that's fine with me, because I'm going to be purchasing at a lower cost than my average cost basis while also generating some passive income. And then what are the last ones? We have BKKT. I sold some covered calls. NNDM, I sold some covered calls. And SPY-G, I sold some cash secured puts, really to get back into SPY-G. I told you I'm looking to build out that position. My average cost on that is 50.56, and I sold the 50 strike. So it is right around my average cost, but I also collected some premium. I was able to collect $15 in premium. So it would bring, in a sense, the average cost down, even more by collecting that premium. And then I'd be able to own 200 shares of SPY-G with a cost basis, below 50.56. So that's it for today's video. If you like these type of videos, let me know in the comments below. I can start making them again. kind of stopped making them just because, I didn't know if people were liking them or not. So just doing it again. If you look here, as far as the dividends, okay, the total yield percentage is about 9%. Annually, it's going to be generating about $3,527 in annual dividends. The monthly average is close to $300 at $293.96.